Guys, if you're wondering exactly how that works, I'm going to show you a tool. I'm going to give you a tool at the end of this where you can see this in action for your own personal situation. If you're sitting there wondering, what does that actually look like for me? I'm going to give you a tracking tool so you can start looking at your wealth goal from now for the future. Because this is the missing link that most people have, and we call it integration. So you need the ability to integrate investing with debt reduction and tax planning. And that's what most of us go through life and never set up and never do. So you need to put in place a systematic, simple, safe, and easy to understand system that enables you to create a large asset base without all the hard work. And that's it. That is, if there's anything you take away from tonight, this is the integration solution. This is the missing link that most of us have. And maybe you're sitting there, you're watching tonight, and maybe this isn't the first time you've heard this information. Maybe you've heard this all before 5 years ago, but never acted on it. Because while integration is so important, it's implementation that is key to your success. And part of that is not having a team around you to help you with this integration and with this implementation. So I want to show you the system. I want you to see the system, how it works, what it looks like. And it looks very much like this. This is the JDL strategy. Now you can see at the very top there we have your home. And there's a golden ring around that home. So this is a finance firewall. And it's gold because it must protect your house. And at the top there, you can see the number one goal of the JDL strategy is to reduce your personal debt. The personal debt has got to go because it is your number one liability. So let's say you have equity in that property. You can then utilize this equity to invest into a second property. Now that second property, at the start you have your holding costs. Over time, as it becomes cash flow positive, as you're getting back your tax incentives from holding that property, and you're using those to pay off your personal debt, it will become cash flow positive. Once it starts hitting that cash flow positive state, you then utilize that asset to start buying other investments. So I want to just first of all say, this is all general information only. This isn't advice. This is our strategy. Because then you can utilize that asset to set up a second property and follow the same pathway on a third and a fourth pathway and diversify your holdings across all asset classes. So you can see here, this gives the example of shares, super, insurances, gold, etc. But it all comes from having a foundation of real estate at the base. Now, if you're wondering, can I set this up for myself? Is this something that I can do personally? Remember, I'm going to give this to you. I'm going to give you access to a tool where you'll see exactly where your numbers are today and what you can start doing. More importantly, you can see what your inactivity is costing you. And we call it the burn factor. I'm going to show you that soon. But before we get there, let's start talking about the two brothers that I mentioned. So I'm going to run this case study. I'm going to give you a bit of information about them first. Now, these two brothers are John and Paul. And they have partners. Their partners are Mary and Susan. So John and Paul, they both own an IT company together. So they started this IT company many years ago, and they first met JDL at the beginning of this journey. So they actually sat and spoke with Julio himself to start looking at designing a strategy. And it was really interesting because when Julio sat down with them, both families were earning the same income. They both worked for the same company, paid themselves the same wages. They actually bought houses side by side on the same street. So they paid $900,000 owing $590,000. The joke at the time was one of them had a slightly better interest rate. They had $50,000 in savings, $150,000 in super, and they were saving $500 per week. So this was how we met them initially. And their end goal was to retire in 21 years on a $100,000 income. So if we start looking at their lives, what would their lives look like if they just continued as they were? If they never used JDL strategies, if they just kept going about their business and made no significant changes whatsoever, the first thing that we can see is they'd be burning more than $2,000 per week. So a burn factor is when you have lost opportunity cost by not investing. It's by looking at how much tax you lost by not putting in place a tax effective strategy. It looks at your lost rent from having cash flow positive assets in the future, and it maps it backwards to say, this is your opportunity cost. And it's almost as much as they're earning. Now, at the moment of retiring, so in 21 years, their desired income of $100,000 per annum would have a value of $191,000. So that's due to inflation. And if we break down their assets, if we break down their current position, you can see here the figures on the side. They'll run out of money in 8 years' time. That's all they have accounted for them. That's with their super, that's with by saving $700,000, by saving $500 a week consistently. They'll only have enough money to retire for 8 years. Now, what about if they start implementing a strategy? So this is where we can start playing with what's possible now. Because by putting in a strategy, these clients have the ability to invest into a property. You'll see this little green bar here. This represents an investment property. So by adding one investment into their portfolio for the next 21 years, it increases the amount of time they could live on with their retirement savings by 5 years. So more than 50%. And that's because of the new equity that's been built into the property. But what if they followed a consistent strategy for the next 20 years? By implementing a chain reaction strategy, by investing whenever they possibly can. The software shows that these clients could buy 4 properties from now until they retire, and the result is they're going to have enough money to last 18 years in retirement. Now, what do those assets look like when we break down the expenses, when we break down the tax portion, the tenant portion? Remember I showed you, what does it cost the investor themselves? Well, we can break down those figures and we can incorporate into this pie chart you see here all the council rates, all the property manager fees, the maintenance costs, we factor in the rent, everything. And you can see that for these clients, by owning this investment property, it's only going to cost them $68 per week to hold that asset. And if we start planning a debt reduction strategy, you can see if they make no changes, it's going to take them 23 years to pay off their personal debt. And if they were to pay off their investments, it would take 39 years. So this is the current trajectory. This is if they do nothing now, they'll have enough money for 8 years. If they do something, it's going to cost them $68 per week to drive a $650,000 asset for the next 21 years. And if they make no changes, it'll take 23 years to pay off their debt. And here is exactly how that tax side of the equation is structured. So you can see by looking at the purchase price of the asset, the construction costs, the estimated debt, the interest rate, and the rent per week. What this wealth goal tracking software does is it starts adding your rent and you're taking off your deductions from your income, and it runs through and looks at what your potential tax savings are going to be by holding this asset. So for these clients, they're going to be saving more than $11,000 of tax. Now, what do you think they're going to do with that $11,000 of tax that they've just saved? Are they going to spend it on a holiday? Are they going to buy a new car? Or are they going to put it towards their biggest liability that they own, which is their personal debt? That is the most effective way to strategize the investments. So let me ask you, what would you do? If you were presented with these options, if you started looking at the figures and started looking towards the future, if you saw your own continue as is, if you saw your own possible now and your own chain reaction, your own JDL strategy, what choices would you make or what questions would you ask? Because John and Mary, at the end of that meeting, they decided not to invest. For Paul and Susan, they did. And I want to now fast forward into the future because I want us to revisit them 20 years in the future. So come with me on this journey. Let's actually go and visit John and Mary and see where they're at now in life. So if we have a look at their continue as is graph, we can see that their net retirement position is less than $1 million, and they're actually going to run out of money in only 5 years. Why is this? It's because they always matched their income to their expenses, and they never committed to saving that $500 per week. Remember, that was a key part of where their funds were coming from, was they had to save $500 per week, but they could not save their way to a prosperous retirement. Meanwhile, Paul and Susan, they decided to follow the chain reaction strategy. So with a team behind them, they sourced assets, they built properties, they saved on their tax, they put it all towards their mortgage, and they followed their chain reaction strategy. And you can see here the different asset classes, you can see the different purchase prices, you can see the different rents that they've achieved. And look at their net position. Their net retirement position actually worked out much better than was initially proposed in their very first consultation. So if we break down the future analysis of the numbers, I'm going to give you, again, all the details of the details. If we have a look at their house, the house is now worth $2 million and they only owe $104,000, but it's not debt-free. Remember, it was going to take 23 years to pay off, and this is 21 years in the future. They do have equity in that property. They've got superannuation, but very minimal savings. Only about 1/10 of what they were required to save to even last for 8 years. And as we can see, 0 extra properties. So what this means is when we minus out the liabilities, the net wealth outside of the home is $976,000. And if we look at what they need in retirement, they'll run out of money in 5.09 years. Now let's compare that to the JDL integrated solution. The home is paid off. Remember, the debt reduction program was established and followed. So they have all the equity in that property. Their superannuation is a little bit less than their counterparts, than their brother. The savings is a lot more. Why is this? It's because once they started having that cash flow positive asset, they started putting that money towards the personal debt and then into offset accounts against their investment properties and started building up their savings. And then when they invested into those extra properties, we can see here that over 21 years, those 4 assets accumulated to a $5.8 million value, of which they have $2.4 million of debt. And when we run the sums, they have $4.792 million of net assets, which is going to last them 25 years of income. This is the best outcome. Based on the numbers, this is their best outcome. So ask yourself the question as well, what is your best outcome? Who would you rather be? Would you rather be John and Mary or Paul and Susan? Because I want to break down exactly what life looks like for John and Mary after they retired. Because in a very short period of time, they had to sell their house. They had to sell the house because that was the only asset they owned with any equity in it to fund their lifestyle. So Paul and Susan, they lived next door and they had to watch their brother, the people that they raised their kids with, sell and move. Why? Because they needed money to live on. Where did they move to? Well, they had to downgrade their home, downgrade their lifestyle, move way, way, way away from where they wanted to be for a short-term solution. Because even if they sold their home and bought $1 million home and had $1 million left over, that would only last 5 years for what they would require. And as you can see, this is where the process starts to speed up as far as using all your funds. And eventually you get into a position just like 85% of all retirees in Australia, where you end up on the old age pension. This is reality for most people. So think about your own relationships, think about your own family, think about your grandparents. Do you have someone in your family where they just suddenly had to sell the home that they've lived in for 30, 40, 50 years? A home that they owned outright? They might tell you it's because they wanted to downsize, they had too many bedrooms. But maybe it's because they ran out of money to live on. Now this is our mission. This is why we exist, is because it's now time for you to find out exactly what you can achieve for your future. Start looking to see exactly how you're going to end up. I want to start a tutorial on our wealth goal. I've just shown you some of the details, but I want you to discover for yourself now how you can minimize your tax legally. I want you to start exploring how you can start building your own portfolio for an early retirement. I want you to see when you'll achieve your own financial independence. Or if not, start looking at what steps you can take to start building towards it. And most importantly, start looking at your debt, your personal debt, at when you're going to pay it off and how fast you can start building a debt reduction program. So what I want everyone to do right now is pull out your phones. If you're watching on a phone, you can see the link here below, but pull out your phones and I want you all to scan the QR code. So this QR code is going to take you to the Wealth Goal software. Now that Wealth Goal software we are giving to absolutely everybody right now to start assessing their own numbers. I'm going to do a tutorial. I'm going to run through it with you as well. In fact, we've just put the link in the chat. So if you're on your phone, I've just been informed, the link is now in the chat. So simply click that link right now and it's going to open up Wealth Goal. So guys, really start discovering for yourself your own situation. We've looked at the numbers. We've looked at where 80% of people fall down. We've looked at why only 8% of Australians give themselves permission to be wealthy. Start seeing where you fall. It's the only way to really start knowing your own numbers. And what I'm going to do is I'm going to run through a tutorial as well. So the question here, I want you to start asking yourself, how often do you check your own numbers? Because that's exactly what this tool is giving you the ability to do. Remember, your numbers have no feelings. We don't often have the ability to start assessing ourselves and our finances. This is your chance right now to really discover where you're at, where you could be by doing a little bit, and how you can start building a chain reaction strategy. What is your own best income? These are the questions that I want to answer. I want to help you answer for yourself. Because that is how, when I was talking to you all, we can deliver the most value. So when our team were looking through the chats, when our team were looking through our direct messages, most people wanted to know how they can get further ahead, how they can be in the best position possible. This is the chance to really start looking towards the future. How are you going to start maximizing your current position and start building the best possible outcome for your life? So the first page that you'll see here is your login page. So on the login page, I'm going to enter some details. My first name, last name, email address, and mobile number. So now we've just registered our details and it brings us to our financial wealth check. So the financial wealth check, this is the section where we're going to start utilizing the advanced artificial intelligence. So we've been working on this software for more than 30 years. This integrates all of your complex algorithms, formulas, serviceabilities, living expenses, tax situations, absolutely everything to give you as accurate a picture as possible on your finances. So let's build a case study. So I'm 30 years old. I'm going to put in my gross income. So if you have a partner, put in the income that both you and your partner earn before tax. So let's say in this situation it's $150,000. I earn $100,000 and my partner earns $50,000. Now how much do you have saved now? Here we're going to put in our savings and also any money that's in an offset account. So I'm going to put in $300,000. Superannuation, if you know your super balances, put in a combined super figure. So let's say $120,000. Managed funds and shares. So if you invest in any share portfolios or managed funds. Personal debts outside of the home. So with the personal debts outside of the home, this is looking at just car loans, personal loans, or business loans. It doesn't include investment property loans. So when I talk to clients, I see all the time that they confuse what that personal loans outside of the home means. So let's say I've got a $20,000 car loan. And of course, I said before, so me and my partner, we're married. Now let's really build this investment engine. Remember, the cash flow that we spoke about at the start is going to drive that investment engine. So I'm saving $500 per week after all expenses. So that includes your rent, that includes your groceries, that includes any money that you're spending after expenses. And how many years before I want to retire? I'm going to say 35 years. And how much do I want to retire on? This is in today's dollars per annum. So let's say that in today's dollars, I want $200,000 in the future. The software is going to automatically adjust for inflation. Next, we come down to our properties. So I own my own home. It's worth $1 million. I have a mortgage of $100,000. And for the investment properties, if you have more than one investment property, put the total of all of your values and the total of all of your loans combined. So for example, if I have 3 properties and they've got a combined value of $2 million, and across those 3 properties, I only owe $200,000. What the software will do is it will automatically adjust to what the estimated rent is. And that's it. So those numbers, if we press save and process, it is now going to take us to our financial wealth check analysis. So is everyone following? I'm going to pause. Has everyone reached that point on the financial wealth check? Let's take a look at the formula. So now what the software is doing is it's putting the control in your hands. So what it's saying is you can start playing with the numbers for what you believe is going to happen in the future. So you can assess whether property, if you think properties are going to grow at 4%, 8%, 2%, 6%, you can adjust it right here. Savings 1%, superannuation 5%. Now I do need to let you know, I'm not a financial planner. This isn't financial planning advice. The super indicator is just a general indication only. To get an accurate superannuation evaluation, you would need to see a financial planner. Managed funds, we've got sitting at 5%, inflation at 4%, and interest rates at 6.5%. But I want to be a bit more conservative, and I'm going to bump that up to 7%. And what you'll see here is these other figures carry over from the previous section, and we can start adjusting the investment values as well. I'm going to leave them as they are for this example. And you can now recalculate your own numbers with your own preferences, your own predictions for the future, and you can start looking to see what those results are. So what these numbers will allow you to do now is really start mapping out your future. It gives you the control. And if we come down here to our continue as is, for our example, so remember we already own 3 investment properties. If we map out this future, you can see here that we'll have $11.5 million of net investment equity at a 5% compounding growth rate. We'll save $1.5 million and have $2 million in super in 30 years' time. But for us, we want an income of $200,000 in today's dollars. So what that looks like in 30 years is $820,000 will buy what $200,000 gets you today. So inflation must be factored into this equation. So have a look for yourself with your own numbers right now. Look at your own continue as is. Start asking yourself the question, are you as far ahead as you want to be? Are you happy with the number that you're seeing in front of you? Well, let's have a look at what's possible now. So in this example, we are looking at a massive burn factor. This is where you're now going to start seeing your own burn factor at play. So for my example, we're burning more than $8,000 per week. Per week. That's the lost opportunity cost. That's the lost tax. That's the lost positive cash flow that we've generated. That's how much we're burning. Now what I might do is I might actually adjust a couple of figures here. Because I'm going to bring it down into some more relative terms. So let's put the savings at $20,000. Let's put our years to retirement at 20 years until retirement. And let's look at our home as being $800,000 and we only owe $300,000. And I'll put the income as $200,000 here. So a couple, both on $100,000 per annum. Let's run this situation. And so this is an example to show you how adjustable all of these numbers are. As you can start coming in and looking at your situation, you can start planning out the future, making a few changes here and there to see what impact that has on your life. So now we can see in this example, the money is going to run out in 4 years. And when we come back to our possible now, we're burning $3,000 per week. And we have the ability to invest into one property. So there it is there it's populated right there. I'm going to adjust as well the numbers up here, back to what we were before. I'm going to drop down my desired income for retirement to $100,000 as well and recalculate the numbers. We run out of money in 12 years. So what the software allows you to do is adjust all of these factors yourself. And that's what I want to highlight here. But in the sidebar, you also have extra features. So we can start asking some what if questions. So what are some of the risks? Well, there are two main risks and what if scenarios. Number one is what if interest rates go up? And so we've built that into the software here where you can start looking at, well, what if rates go from 7% to 8%? What does that look like for me as the investor? What's that going to do for my cash flow? So you can see here it goes from $116 per week to $200 per week in our cost to hold the asset. Now the other risk is what if someone doesn't rent my property? And so for this example, we can see here that with a 2-month vacancy rate, it would cost $164 per week to hold that property once you annualize those costs throughout the year. And I can break this down even more by doing the quick analysis. So the quick analysis, first of all, it's going to show me how long it's going to take to pay off my debt by implementing a debt reduction program. And so for our mortgage here, we'll pay it off in 10 years and own the investment in 21 years. And by using other people's money, you can see here we are bang on 15% as far as our cost for holding this asset is concerned. So the tenant is going to show up and they're going to contribute 55% of all the bills, or $22,500. And the tax man is going to provide $12,700, which means our cost to hold is only $116 per week. And that's at a 7% interest rate. You see, we can break this down here in the property analysis and we can start looking at what those costs would be. So this is what you would take to your accountant. This is something you would show your accountant and say, hey, if I'm buying this property and these are the details here, this is the construction costs, this is the age of the property, this is the potential rent and the interest rate. You can start mapping out and looking at exactly what the total income is, your new income position, minus out your deductions to give you a new taxable income figure. That new taxable income figure, what it drops you down from is $100,000 to $82,500. And essentially it means that the tax you paid on your $100,000 for the year was more than what your taxable income ended up being at the end of the financial year. So that difference between them is the total amount of savings that you will have as far as your tax is concerned. So there's the tax minimization strategy at play. And so what do you do once you receive this lump sum? We've already gone over it. We've spoken about it many times. You want to put that directly into your personal debt. You want to drive that liability down as fast as possible. And this is how you start building the chain reaction strategy. Because if we come back to our possible future and we ask the software to show us what is our best possible outcome for the next 20 years, well, the software maps out and it says we can invest into 4 properties over the lifetime of our career. You see, the software has no feelings. It's running the numbers constantly. It's looking at your income. It's looking at your inflation. It's looking at your total debt to income levels. And it's assessing when you're going to be at a point each time to make your next investment. And so that's what it does, is it buys those properties for you. And then it shows you your results. Now, one thing it can't do, however, is it can't give you an exit strategy. So what do I mean by this? When you hit your retirement age, the software is designed to sell all of your assets, move them into cash, and you live off that cash for as long as you possibly can. Why? Because it's probably not the smartest decision to make with all your assets. When you hit this point in time, when you start looking to retire, that's when it's important to get yourself a financial planner and to start putting together an exit strategy. Because what you might find is in 18 years' time, this property is cash flow positive and it's paying for this property. You might be able to sell one to pay off two. A whole range of options open up to give you that best outcome possible. Just like Paul and Susan. And so that's your projection comparison, guys. So that is how to utilize the wealth goal tracking tool to be able to start mapping out and seeing your own numbers as far as continuing as is, what's possible now, and what your chain reaction would be. This is wealth goal, and it's your tool to use now. So I'm going to come back now to the slides. And I want to start diving more into us and what we do, because we here are a community. We've been doing this for more than 30 years. So we have dinners with all of our clients to discuss the future, discuss investments, discuss our strategies, but more to get together and really connect. That's what we do. We're a team here that facilitates the future. And I'm going to run you through a few case studies. So the first case study are Jonathan and Chelsea. So they're clients of ours who started back in 2019. They invested into one property. And as you can see, that one property for the last 4 years has increased by $231,000. And it's given them a 42% return. Now, when you annualize this, what that really means is while they're working, while they're still living, while they're doing everything they're doing, they have an asset that's for the last 4 years been increasing by more than $57,000 per annum. And what impact this has on their taxes and their strategy and their debt is they're now saving $9,500 in tax, and it's reduced their mortgage by 4.3 years, and it's costing them $67 per week to do so. So just think about that. It's costing $67 per week to have an asset that's increasing by $57,000 per annum. And we can look also at Hayden. Hayden's a client that I've worked with personally, bought his first property in 2021. Then he bought his second property. It's now under construction in Victoria in 2022. So that first property over the first 2 years has seen his asset position grow by $249,000. And what does that mean? Well, it means it's grown by 39.3%. And if we have a look at his savings position, those two assets are saving $21,000 of his tax per annum, and it only costs him $112 per week to hold those properties. Robert and Rebecca, they're a bit more advanced. They hold what we call the trifecta. So they've got 3 investments across the 3 main states, New South Wales, Victoria, and Queensland. And as you can see, over the lifetime of their investment journey, the 4 years that they've been with JDL, is their assets have grown by $612,000. So that's growing at $200,000 per annum for them. Per annum. That's almost as much as they're earning in income, just by having these assets working for them in the background. And by building the best possible scenario, they're saving $32,000 in tax, redirecting it into their personal mortgage, and reducing that loan by 12 years in mortgage time. because they're putting that money directly onto the principal. And all it's costing them is $200 per week to hold those 3 properties. And then we get into one of our advanced clients, someone who's been with us for close to 10 years, or more than 10 years. 12 years is James and Gina. And they've actually invested into 6 properties. And you'll see as we go through, their diversified portfolio has different levels of growth because they're across different markets. So you'll see here that some properties have grown a lot, some properties have grown not as much. But overall, what these properties have done for these clients is it's increased their equity bank by nearly $1.3 million over a 12-year period. And for a tax and debt strategy impact, it means they've saved $480,000 in total tax, and they reduced their mortgage by 18 years. And now, because most of those properties they started a very long time ago, 12 years ago, those properties are cash flow positive. So now, while they're growing in value by $100,000 a year, it's also putting $20,000 per year into their pocket because the rents have increased, the debts have stayed the same or gone down. And so every extra dollar is redirected back into that personal debt. This is the chain reaction strategy at work. This is exactly how it might look for you. And so what do we do as your team? So JDL Strategies provides this integrated solution. And the way that we do that is we work with you across these elements. We work with you across the finance side of things, the property side. We work with you on your software, both your wealth goal and your internal software. And we provide education. So we are at our heart an education-based company. We want you to learn, understand, and know for yourself exactly what's possible. And I'm going to introduce you to our team. So in our finance world, everybody knows a good broker. Anybody that you talk to, friends, family, they'll tell you that they know a good broker. But what does a good broker actually do? A good broker he gets you the money. It's an excellent broker who's going to provide the difference. And we have 2 excellent brokers here at JDL Strategies. So I'll introduce you to Scott and to Michael. Now, Scott and Michael, they have 50 years of experience building finance strategies for all Australians. And the real difference is that an excellent broker is going to find you the best money and deliver you the most aggressive debt reduction strategy. So their goal is to show you how to get out of your bad debt, your personal debt, as fast as possible, and how to utilize good debt or investment debt to plan for the future and build for the future. That is the difference between a good broker and an excellent broker. Now let's have a look. So these excellent brokers, they have access to over 90 different lenders. Now that's huge. So here at JDL, we're completely independent. So our mortgage firm can look at every lender they possibly can, all 90 of them, to find you the best interest rates, to find you the best mortgage products, and to find you the best mechanism to reduce your debt. That is their number one goal for you. Because when you start integrating the chain reaction with a debt reduction strategy, well, what that looks like is a way to build your investment engine faster. And one example here, so one of our clients who came through without JDL, so they were on track to pay their mortgage off in 13 years. You can see here the details. They had $350,000 of debt. When we ran the numbers through the Wealth Goal software, that was exactly how it looked on the software as well. With JDL, so working with Mike and Scott, they figured out a way that they could help this client with the assets they already have and new assets, how they can pay that debt off in just 4 years. 4 years. Now, how incredible is that to go from thinking you're not going to own this home for 13 years to now you're going to own it in 4 years? That is the power of having an excellent broker working with you. Next, we have our property sourcing division. So our property sourcing department, their role is to source and acquire and buy assets on your behalf, the best assets they possibly can, and manage the process throughout to completion. And now I'm going to introduce you to Jessica Donald. Jessica Donald is the department director. She has been here at JDL Strategies now for 13 years, and she has sourced billions of dollars worth of real estate for our clients. And that's billions with a B. So she has a 13-year knowledge base and experience, and she drives her team to be responsible in acquiring the best real estate opportunities for our clients. So what they do is they will conduct all of the market research for you, prepare all the proposals, do all the negotiations, collect all the reports and the research, and then ensure that all the requirements are met for any asset that she sources. On top of this, she provides ongoing support for clients, so in order to help you continue managing your property portfolio and your investment strategy. And guys, I'm going to show you, because the level of detail that her and her team go to is second to none. The research that Jessica will deliver to you, I'm going to show you here with some redacted information, goes extremely deep. So we provide our clients with a 44-point checklist. And what this 44-point checklist does is it analyzes the investment location for 44 parameters that we in our 30 years of history believe will lead to an investment that long-term delivers you your growth. So you can see here some of the areas that it covers, looking at schools, public transport, shops, medical facilities. She also gives it a score at the end out of 44 to let you know where the parameters were met, where they weren't met. And it's also interactive. So you might say, well, I don't know if I agree that there's access to motorways. You can click that Y or click that click here button, and it will take you directly to her research. At the same time, of course, she's going to give you suburb analysis, city analysis. She's going to give you state-based analysis, everything for that sourced investment. Now, of course, throughout this journey, you need someone who's going to be step-by-step, every step of the way with you, and that is your client manager. So as the national client manager here, my role is to coordinate the team, and what we do is we coordinate real estate strategies for you, our clients. So we're like your own project manager or your financial secretary. So in order to be an effective client manager, our role is to understand you, your needs, your goals, and your objectives. We then need to look at you and find your inefficiencies and start building you that integrated solution. So client managers, they have a strong understanding of the real estate market, a proven track record of successful client experiences, and they need to be there for you every step of the way. So that is what a client manager does. That's my role. And then, of course, you have our CEO, Mr. Giulio Delafite. So as the founder and CEO of the company, Giulio provides all of our strategic direction and leadership. He manages our executive team. He's successfully helmed JDL Strategies for the last 30 years and spoken at Parliament numerous times about the future of the Australian economy. So if there's any expert to listen to, Giulio has the experience and he's delivered to Parliament. So if you aren't already, I would ask that you follow us on Instagram at JDL Strategies. You can catch all of my stories. Now I'm going to look to see if there's any comments as far as before we look at what we delivered. Are there any comments that have come through? So there's a comment from Tim saying positive cash flow properties are harder to get as interest rates rise. That is very true. But if you can access them, then you're onto a winner. Keep the cash flow flowing. That is a great point to make, Tim. Exactly 100% correct. But also, it's important to know how being cash flow positive works. Because being cash flow positive also comes down to how long have you held the asset? What are the rents increasing in the area? What are the rates of rental increases? Because you might find even with the high interest rates now, if they start coming down over the next 12 to 18 months, if you're in a great area that has a high rental return, you'll see that you'll become cash flow positive quicker and it'll be at a more prolonged period, perpetually. So did we deliver? Guys, have you learnt now how you can pay off your mortgage years earlier? Have you learnt what a mortgage is, how it's structured, how you're being set up to fail? Have you started looking into now knowing how to achieve financial independence or how you can build a retirement portfolio? Did you use the Wealth Goal software? Have you saved the link to look at it later? Do you now understand how to minimize your tax legally and how you can start doing it perpetually? And finally, I hope that you've learned now how you can start looking to build your financial life, your real estate portfolio, and looking at opportunities beyond what you are doing now. Guys, if we delivered, I want to see a thumbs up. If you've got your cameras on, give me a thumbs up. But otherwise, everybody, I want to say thank you so much for being here with me tonight. Thank you for attending our JDL Digital event. I would like to reach out to everyone tomorrow or over the next few days to get some feedback, to have a chat, and to start working with you on setting up your own strategy. So once again, everybody, thank you so much for being here, and I'll speak to you soon.